You're listening to The Dealmaker's Edge with A.Y. Strauss, diving deep into stories behind commercial real estate leaders. Hello, everybody. Welcome to The Dealmaker's Edge. Today, we are joined by Derrick Barker, who's the co-founder and CEO of Nectar, which is a real estate tech financing company. Derrick is going to share his journey from going to school at Harvard, working as a fixed income trader at Goldman, buying real estate aggressively at a young age, coming out of the GFC while he's still at Goldman, building a portfolio, multiple brands in real estate, and finally the story of how he developed Nectar as a business model, one that he actually needed himself at times during his development experience. So without further ado, here we go. Hope you enjoyed the episode. Hello, everybody, and welcome Derrick Barker to the podcast. I know Derrick's actually been feeling a little under the weather lately, so I appreciate you taking some time, and you get a pass. It's nice you to power through. I appreciate you being here. Your career's been really exciting to date, and you're doing a lot of interesting things, and thanks for making the time. And I'd love for our audience to get to know you, to share your story. And if you wouldn't mind, maybe you could talk about where you grew up and then from college and what you did thereafter. It'd be wonderful.
Thanks for having me on the show. So where I grew up in Southwest Atlanta, in the Atlanta, Georgia area. My dad was in the military, so I was a military brat. So I moved all over. But since my mom and dad met in middle school, both families were in the same neighborhood. So I kept coming back to Atlanta. It's also where I graduated from high school at Westlake High School, which is southwest of the city. After high school, I ended up going to Harvard University. I played football there and started a student organization that ended up growing really quickly and being my first real big business success. So that's kind of how I got into. I was always an entrepreneur. I started little businesses in high school that honestly helped pay for all of my high school desires. But that was when I really got into business. But it was connected to Wall Street. We were connected to all of the investment banks and large PE shops of our customers. And I started college in 2006 and 2007 and 2008. So it was really a great business in 2006, and he was good in 2007. And then in 2008, it went away. I always thought I was going to go work in Wall Street because growing up, I wanted to be an astronaut. But when I got into Harvard, I was the first person from my high school to ever go to Harvard. My dad and everybody was like, "Hey, well, go do something and make some money." Because we weren't. I was kind of the goal. I figured out, I'm cashing in this degree in some kind of way. And everybody at the time who's wanted to go make money went to Wall Street, went to work at Goldman Sachs. So after 2008, I was like, well, there's going to be no Wall Street, so let me figure something else out. And that's how I got into real estate. I was like, well, real estate has crashed. If I'm going to be young and get started, I might as well start now when everything is kind of falling apart. So from growing up in Atlanta, playing sports and making it to get in the real estate industry.
That's great. When you were at Goldman from 2010 to 2013, you were fixed income, right? You're a fixed income trader. What was the environment like? I guess that was the very tail end of the GFC. Lehman had just collapsed in 2008. So all of Wall Street must have still felt like a total shell of its former self. What was the vibe like there? Did you like it? Was it fun? Did you hate it?
Honestly, it was great for me. I left. It was great for it to be a young person. And, I got there right after. So I got into real estate, but then it turns out I still got a job at Goldman on the trading floor, trading fixed income. And it was kind of like entering into the scene after a big disaster had happened. Literally, that's how it felt. That was the vibe. You can tell something bad had happened. You still had remnants. There's still people getting fired and leaving and crying. On the from the trading floor. There's still there's still issues, but it was a lot of hearing stories. When I was there was still a lot of volatility, especially in some of the fixed income markets. We traded structured products. In tax exempt structured products, and there was a lot of volatility. So you still saw there was a lot of excitement. There was also a lot of periods of low volume. But one thing about Goldman, I got to learn what it meant to be a professional, what excellence looks like, how to manage risk. They give junior people a good amount of responsibility, a tremendous amount of responsibility, honestly, at a very young age. And I benefited from that tremendously. So it was really good.
It's a first-class organization, so it gives you a polish that you don't have if you don't spend that time at a big Wall Street shop. And I know, if I'm getting it correct, while you're at Goldman, while you're managing that, probably super stressful job, you were also buying real estate too. You bought, I think, hundreds of apartment buildings, hundreds of units, I should say, in Atlanta during that period while you were also at Goldman at the same time. Is that
Yeah, so when I was in college, I started buying real estate with a couple of my college roommates, and 'cause we didn't know we were gonna be able to get jobs. Turns out we were also able to get jobs, and then I kept that going, and yeah, at Goldman, it was an intense job. Like, it wasn't a, chill job, but it was great. But yeah, I would continue to buy and build real estate. I always wanted to be leaving my home. I always in seeing how it was decimated by the financial crisis. I always wanted to see what can I do to come back and rebuild the community that really created me, where I came from. And was able to do that while at Goldman, continues to buy and renovate first single family, then quads, small apartment complexes, and then eventually larger apartment complexes. Even while I was at Goldman, by 2023, I had about 500 units, a little over 500 units down in Atlanta. And at that point, it was time to, sorry, I said 2023, I meant 2013. And by that time, it was probably time to go ahead and, my boss was like, what are you doing? Are you a real estate guy? Or are you a trader? And I had to, got to a fork in the road, and I decided to come and really continue to rebuild, um, you know, back at home where I grew up.
that's awesome. And I know you've built under a few brands. You've had this, if I'm saying the names wrong correctly, but Civitas Communities, DOMOS Co-Living, and then
Mhm.
more recently, this super cool venture, Nectar, which we'll certainly talk about. But maybe you could talk about a couple of the brands you've been building under co-living space, which I know has had certain iterations, especially in New York. I've watched it. And Civitas Communities, I imagine, was kind of like the core buying vehicle for traditional multi.
Yeah, so we started out no brand actually. We were just buying properties, then we started Civitas. So my first organization I started with my roommates was Koreatown, which is a Lighting for Truth. We started that, and it became really big, so we felt like we were gonna keep going with the Latin. So Civitas is just Latin for community. We were building communities. We were going in, we're buying really distressed assets. A lot of them had gangs, a lot of them had were really dilapidated, and we were creating communities. We're gutting the assets. We were like putting in new management. We were making them much nicer. We were kicking out the gangs. We were putting in not services, working with nonprofits. We were getting after school programs for the kids, building real communities. Turns out that was a hugely profitable business model. You take something that was a blight that nobody wanted and was really cheap at the time in 2010, 11, 12, 13, 14, 15. Those were, you bought them cheap. And then if you built the nicest thing in the community, all the people who live there, who have good jobs, you want to be in the community, they come. You'd be surprised how much demand there was just for quality communities. So that's what we did with Civitas. DOMOS Co-Living, what we saw was a lot of people, as we push rents. I mean, it costs money to do all this construction. You push rents go higher. There were a lot of families, but there were also just single people living together. And there's just inefficiencies with that. When one person doesn't pay rent, or when there's, one person wants to move out but who takes the TV, so we figured that we could kind of help facilitate that, and we started the co-living concept. And that worked tremendously. It worked tremendously. We were able to rent by the room, and then so we continued to expand that. We expanded that in Domos. We tried to build some things ground up, but it turns out that we were much more successful just buying apartment complexes and taking the larger floor plans and bringing them out by the bedroom. And even today, we have maybe about over 100 of those units.
That's great. How about raising capital? Did you bring in a lot of outside capital? It was friends and family to start? Did you scale up to a certain level of investment?
Almost all of the capital that we raised, especially initially, was from high net worth individuals and family offices. It wasn't, we didn't have very wealthy friends or family to start out, but we were, when I was at college, we raised money from some donors, some of the people who were donors to Harvard and endowed scholarship. And then we got a reputation, and we raised money from local high net worth individuals. As you kind of get a reputation, flip a few deals, the communities, the real estate communities are just not that big. And they certainly weren't. Like Atlanta was not a huge community, like real estate community back in the 2010s, early 2010s. So when you have a reputation, you start to just meet more people who are investors, who invest in other deals, and they see how we operate it. So a lot of the way that we got financing were just a few families, an older real estate family who the patriarch built a large portfolio, and he came in, he helped us to get started. He co-signed our debt. He helped us with some coaching investment, and introduced us to some friends. You had a lot of that when you first started, and you have a few people doing that, then you get to meet a lot of people. And that's really how we got started, and then built relationships, we made good returns, and kept going.
That's great. And then I think your current venture, Nectar, if I'm correct, really sprung out of a demand that you yourself witnessed when you were growing your portfolio, that you can have a really nice asset mix. You can have great cash flowing multifamily real estate, great long-term assets, but there's always a short-term cash flow need, whether you need to do CapEx, or you need to buy another property, or you need to take out some funds personally that perhaps you just can't, because you can't refinance the whole property. So you created your own proprietary business to solve for that specific question. Maybe we can just talk about Nectar from a big picture. First of all, did I describe that history
Yep.
correctly? And then maybe you could just walk us through the company from a macro perspective, what it is, what the value provides, and what it's doing would be great.
Yeah. So I started Nectar. I built a real estate business. We had multiple properties that were stabilized in different phases of development, and yet we still had capital needs. Specifically, we were under contract to buy a property in Koreatown, in LA, and we needed to. We were under contract. We were about 4 days before our earnest money went non-contingent, and the lender pulled back proceeds, and we needed to add another $500,000. And with the liquidity covenants, with the equity that we already had committed, with all the other just pools in our liquidity, I was like, well, I just don't have another $500,000 I can just put in at the moment, and without being a real strain in the business. But we have these assets. We had 40%, 50% leverage assets, 60% leverage assets, that we didn't want to refi, but they have plenty equity in them. And I said, well, it doesn't make sense that I can't get liquidity in any way in order to fill this gap. So that's really where I decided, hey, sponsors, commercial real estate property owners need a way to access the liquidity that they have trapped in their assets. A lot of sponsors own stabilized cash flowing portfolios. They have equity. And so what Nectar does is we provide liquidity to these sponsors so they can continue to run their businesses. When I built Nectar, we said, hey, for this company to work, it needs to be a true technology company. I was not a technology person, so I went through Techstars. I got into the technology universe, and we built core technology to operate as a tech-enabled lending company. And in the age of AI, an AI first, AI native company at our core, and we provide AI tools and products to our customers so that they can be more efficient and run their businesses more efficient as well.
It's very cool. And so how does it work vis-a-vis the sponsor who has an existing loan on the property, is not allowed to encumber it any further? It's probably a breach of the loan documents to say I'm going to put any other debt whatsoever. So how do you secure your loans that you're making to these sponsors?
Personal guarantee. Typically, we can lend against an entity that it doesn't have to be the property owning entity per se, but we always have a personal guarantee, and we always attach to a equity structure. Really, it's effectively a structured equity type structure that allows us to attach and not require our sponsors to trip any covenants. Tripping a covenant on your loans and going into default is not helpful for anybody. So
No,
we are
for sure.
specifically. Yeah, we're specifically flexible so that we can make sure to provide the capital in a way that works with the existing capital stack.
Okay. So more like a pledge the membership agreement or something along those lines that works within the scope of the loan. And it certainly is a great need, obviously, because I saw you did more than 140 deals across 29 states. You've put out over $40 million in the product, which is still pretty new. And certainly liquidity has been the name of the game in the last several years with rising interest rates and everything else. What are your plans for Nectar broadly? Do you want to really scale it to a significantly higher level? Do you like where it is? How's it capitalized? Do you need more equity for that, for the core business itself?
We're decently well capitalized, and we've been able to, generate, quite good returns. But we do want to scale. We are looking to scale. As I said, we spent a good amount of time, really, especially as AI has developed, building our like AI native processes so we can just be very fast and efficient and have a scalable platform to allow us to do more and more deals. And that's our goal. Our goal is to be a provider of both data and liquidity to lower middle market and middle market sponsors in the commercial real estate space.
That's awesome. I know you're in business with your wife as well that you met in college. Is that
It's true.
rewarding to work with a spouse every day? I had to choose the right word very carefully, because my spouse could be listening, your other spouse could be listening. But I know it's not always the most simplistic thing, but clearly it works. And it seems like you've been in business together, throughout your whole relationship.
That's true. That's true. We met when we were teenagers, actually. We started our first organization together when we were in college. We started a business together to help pay for our wedding, actually. At the time, I had just left my job at Goldman, and I had this real estate business that was really sucking cash. It was taking all of our money, in liquid. And we were like, well, how do we do this? So we started an import-export business. So we've been running businesses together for a long time. We have very complementary skills. So it helps. We have a good partnership where I do certain things that are my things. She does certain things that are her things. I know that she has my back. I have hers. And that helps. Plus counseling. So I say those things make it
That's great.
very, very, very rewarding because we know that we're aligned.
When it works, it works. That's awesome. How do you manage? I mean, you're clearly just an entrepreneur through and through. You've started and scaled businesses. You love being in the business world. You're very creative. But like we alluded to, there's a lot of ups and downs. There's cash crunches, there's equity issues, there's investor issues, there's day-to-day failures. I'm in the failure business too. All we do is try, make mistakes, move on again and again. But how do you manage the mental headspace that goes into being an entrepreneur? Because it's very lonely. It's very discombobulating and disorienting. You have your spouse as a partner, so you have someone to talk to. But I mean, how do you manage the headspace in a way that allows you to keep moving from business opportunity to business opportunity, riding the highs and lows? Because that's a big thing too. It's called the Dealmaker's Edge. We try to get to this point because a lot of people listening to this are probably on the cusp of launching their own business, their own portfolio. They're struggling. Everyone's struggling in their own way. But how do you manage your headspace? Would be very compelling to hear.
I mean, you have to be anchored to something other than the next success. Because what's more likely is the next failure. Like entrepreneurship is mostly failure with like some highs, some like big highs. And it's like my one old mentor said is in entrepreneurships you have higher highs and frequent lows or something like that. So and that's true. But you have anchor. I have an identity that's anchored in something else. I'm also just like I'm a believer in like Jesus and Jesus Christ, and that is something that that's where I anchor my faith. So I'm not worried about the ups and downs because I know that in the end I'm going to have what I need. I have what I need today. I'm here. I have a warm house. I have a beautiful family. I have people. I'm surrounded by people who love me, and I get to go on adventures every day. And you have to just be down for the adventure every day and for that life. And sometimes when you're going on an adventure every day, you're going to come back and you're going to get punched in the gut. And that just is what it is. And if you're not ready for that, then don't do it. That's because that's most of what it is. And you have to be down. You have to be able to have that and then come home and then hug your kids and then kiss your wife and say, today was a great day. And that's how
I love that.
That's legitimately how, like, you lost a deal. We lost some money. I come home and it just is it's the life I chose. And today is still a great day.
I love that. That's really, really compelling. Faith as a value, very powerful. Always a ton of respect there. And of course, gratitude. Without that gratitude, what's the point? Because there's always negative things to focus on every day, and then you'll waste your whole life just harping on those few downer points. But there's so many wonderful things to be thankful for. Your health alone. I know you're going through it right now, but I'm glad you're up for this conversation.
one other thing I say about like a way to make it is like in the real estate business, at some point you're going to make some money. Okay. Hopefully, uh, stay low leverage. That's what I said. Stay low leverage and have cash flow. So we are able to take a ton of risk, and we do take a ton of risk. But when it comes down to it, our actual life is very low leverage. Our actual household has positive cash flow. Like we have a low leverage cash flowing lifestyle. And then we take a lot of risk. And ultimately, like I'm not living on my net worth. I am going on an adventure with my net worth, and maybe it'll be bigger and maybe I'll wipe out, and it's all okay because my life is low leverage and cash flowing and is not leveraged to whatever the next success is. So that's another thing that gives you peace of mind.
That's super important. Super important. The best way to put yourself out of business is to live as if you're always going to keep earning more and more and that there's never a downturn, because ultimately lifestyles, it's hard to pare them back, but it's relatively easier to not get to some crazy lavish lifestyle to begin with if you can. So very meaningful for sure, and managing that flow. Anything else, Derrick, I could have asked you, but I didn't, or I forgot that you'd love to share? If somebody gets on your calendar, says, meet me for coffee, I'm starting my career, give me some advice, talk to me, like what are those points besides which we've already covered?
In the age of AI, relationships matter more. Like, they matter more than they ever have. So get in front of people actually. So I say that's one thing that's just crucial. However, also figure out how to leverage AI. I mean, but I'd say pair those two things, like figure out how are you going to invest in yourself so that you know that you're equipped to leverage the tools that exist today because they're powerful. And there's nothing more powerful than relationships. So make them, get in front of people, go to, find the people who are doing the things, figure out how to be helpful, go to the conferences, pick partners well. Another thing, like, who you're partnering with, you never know where they're going to end up. So treat them well, but also pick them well. Like, because bad people can create, bad partners can destroy perfectly good deals. And if you're looking to invest in invest it in some low leverage cash flowing assets, we do have a fund, where we have, several dozen low leverage cash flowing assets. We make 12% distributions every quarter, and we have for the past 3.5 years. If you're interested in getting in from a sponsor perspective, get out there and tie your deal up, and don't be afraid. You're gonna probably lose money whether or not.
That's great. Yeah, fear is an obstacle. Keep moving forward. Have faith, discipline, focus, family, good mental health, physical health. That's what it's all about, right, Derrick? But listen, I really appreciate taking the time. I'm going to watch your career continue to be successful. Nectar is a super cool product. Can't wait to play around with it a little bit. And just keep doing great work. Keep being a role model, an example, a success story. A man of faith. This is all great stuff. And I really appreciate the time today. I wish you so much continued success in good health, and we'll continue to watch the success. So thanks again, Derrick, for making the time. Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. And please give us a 5-star rating so more people can follow the conversation.